Nvidia has added more market value in 2 years than the entire GDP of France. Microsoft, Google, and Meta have collectively invested over $300 billion in AI infrastructure in a single year. Goldman Sachs says AI could add $7 trillion to the global economy by 2030. And Warren Buffett, who has studied every major technology boom of the last 60 years, has said almost nothing about it. Not because he is not paying attention, but because what he has said quietly, carefully, in the margins of annual meetings and shareholder letters, tells you everything about how he is approaching the biggest investment story of a generation. He has not bought Nvidia. He has not bought Microsoft's AI infrastructure play. He has not bought any of the high-profile AI hardware or software companies. But he has made one significant AI-adjacent investment. And understanding why he made that specific choice, and not the obvious ones, reveals something fundamental about how his framework applies to a technology boom. In this video, I'm going to walk you through exactly what Buffett thinks about AI stocks, the 5 angles through which his framework evaluates this technology, and what his silence on most of it actually means. Angle 3 is the one that will permanently change how you think about the AI investment landscape. Stay with me. Let me start with Buffett's track record on technology, because it is more nuanced than most people present it. He avoided the dot-com bubble of the late 1990s entirely. While every institutional investor was loading up on internet stocks at 100 times revenue, Buffett held Coca-Cola and American Express. He underperformed massively in 1998 and 1999. Then the bubble burst and he looked like a genius. He missed Amazon. He missed Google. He has acknowledged both as mistakes of omission, cases where he understood the business well enough to invest but did not fully appreciate how durable the advantages would be. Then, in 2016, he bought Apple, a technology company, and built it into nearly 50% of Berkshire's equity portfolio. This surprised everyone who had categorized Buffett as a tech avoider. His explanation: he did not think of Apple as a technology company. He thought of it as a consumer products company with an extraordinary ecosystem moat. So Buffett's relationship with technology is not simple avoidance. It is a specific filter. He does not avoid technology because it is technology. He avoids technology investments where he cannot reliably predict which companies will capture the value, or where current prices do not offer a margin of safety relative to that uncertain value. AI is going through that filter right now. Here are the 5 angles through which his framework evaluates what is happening in artificial intelligence. Circle of competence. Does he understand who wins? The question Buffett asks. The first filter Buffett applies to any investment is the circle of competence question. Do I understand this business well enough to predict its competitive position in 10 years? For AI, this question has a specific and uncomfortable answer. Buffett has acknowledged that artificial intelligence is clearly important and clearly powerful. He has compared it to the development of the atomic bomb, something that fundamentally changes the world. But he has also noted that knowing a technology is important is very different from knowing which companies will capture the economic value that technology creates. The internet was obviously important in 1995. Knowing that did not tell you whether Amazon, Google, or some company that did not yet exist would be the dominant value capture vehicle. Why he is cautious about AI stocks specifically. The AI investment landscape currently has multiple potential value capture points. Semiconductor companies like Nvidia that make the chips, cloud infrastructure companies like Microsoft and Amazon that host the models, software companies building AI applications, and end-user businesses that will deploy AI to reduce costs or create new products. Buffett's framework says, if you cannot confidently identify which layer of the value chain will capture the most economic value over 10 years, you are outside your circle of competence. The history of technology booms suggests that the obvious early winner is rarely the ultimate economic beneficiary. In the PC era, the obvious winners were computer manufacturers. The real winners were Microsoft and Intel, companies providing the software and chips that worked across all manufacturers. In the internet era, the obvious winners were internet service providers and portal sites. The real winners were Google and Amazon, companies that built on top of the infrastructure. In AI, the obvious current winner is Nvidia. Whether Nvidia remains the dominant value capture vehicle as the technology matures, or whether the value shifts to the model builders, the application layer, or some unforeseen competitor, is precisely the kind of question Buffett says he cannot answer with confidence. What you do. Before investing in any AI company, ask Buffett's specific question. Can I confidently predict that this company will be in a strong competitive position in 10 years? Not will AI be important in 10 years. It clearly will be. But will this specific company be the primary economic beneficiary? If you cannot answer that with specific reasons, not just enthusiasm, you are outside your circle. Angle 2 is about valuation, and it connects directly to what Buffett said about the dot-com bubble that most people have forgotten. Valuation, paying any price for a certain future, the dot-com parallel. In 1999, Buffett gave a famous speech at Sun Valley in which he outlined why he was not participating in the internet bubble. His argument was not that the internet was unimportant. He acknowledged it would transform commerce. His argument was that the prices being paid for internet companies assumed a level of future dominance and profitability that could not be reliably predicted, and that almost no price was too high in the eyes of the market because the story was too compelling. That dynamic, where a genuinely transformative technology drives valuations so high that even a correct prediction about the technology does not produce investment returns, is exactly what Buffett watches for. The AI valuation question. Nvidia, at its peak in 2024, was trading at approximately 35 times revenue and over 70 times earnings. Those are valuations that require extraordinary execution, not just good performance, but the kind of performance that sustains or grows that competitive position for years while delivering earnings growth that justifies the premium. Buffett's valuation framework says, the price you pay determines your return. If you pay 70 times earnings for a business, you need earnings to grow dramatically just to produce average returns. The technology can be genuinely revolutionary and the investment can still be poor, because the revolutionary transformation was already in the price. He watched this play out with Cisco in 2000. Cisco was genuinely dominant in the internet infrastructure that everyone needed. It was not a fraud or a bad business. But at 200 times earnings, even perfect execution produced terrible returns for investors who bought at the peak. What you do. For any AI stock you are evaluating, model the earnings growth required to justify the current price at a reasonable future P/E. If the answer requires 30 to 40% annual earnings growth for 5 consecutive years, ask honestly how many technology companies in history have achieved that. The answer is very few, and the ones that did were almost impossible to identify in advance at the moment of peak hype. Curiosity gap. Angle 3 is the one I have been building to because it reveals the specific AI investment Buffett has actually made. And the reason behind it is not what most people expect. The actual bet, Buffett's hidden AI investment, the investment nobody is talking about. Buffett has not bought Nvidia. He has not bought Microsoft. He has not bought any of the obvious AI beneficiaries. But Berkshire Hathaway Energy, his utility holding, has committed billions of dollars to electricity infrastructure. And that connection is more important than it appears. The AI boom is, at its physical foundation, an electricity boom. Training large AI models consumes extraordinary amounts of power. A single training run for a frontier AI model can consume as much electricity as a small town uses in a year. Data centers running AI inference, the process of using trained models to generate answers, are projected to consume between 3 and 8% of total U.S. electricity by 2030, up from less than 1% today. That electricity has to come from somewhere. It has to be transmitted through power grids. It has to be regulated by utility frameworks. And it has to be expanded at enormous capital cost to meet demand that is growing faster than the grid was designed to handle. Why this is Buffett's version of the AI trade. Buffett does not need to know whether Nvidia remains the dominant chip company. He does not need to predict whether OpenAI or Google or some company founded last year will build the dominant AI model. He does not need to know which AI applications will generate the most revenue. He just needs to know that AI will require enormous amounts of electricity, which is as close to certain as any prediction in technology. And he owns the electricity. Berkshire Hathaway Energy is a regulated utility. It earns predictable returns on capital investment set by regulators. As AI drives electricity demand higher, the capital investment required to serve that demand generates regulated returns. The more electricity AI needs, the more capital Berkshire Hathaway Energy deploys, and the more it earns. This is the classic Buffett approach to technology booms. During the gold rush, sell shovels. In the AI boom, sell electricity. He is not betting on which AI company wins. He is betting on the infrastructure that every AI company needs regardless of who wins. What this teaches: when evaluating any technology boom, look for the infrastructure layer, the picks and shovels, that benefits from the boom regardless of which technology company ultimately wins. In the internet era, the shovel sellers were fiber optic cable companies, data center REITs, and cloud infrastructure providers. In the AI era, the shovel sellers include electricity utilities, grid infrastructure companies, and cooling technology providers. These businesses do not require predicting winners, only predicting adoption, which is easier. Angle 4 is about what Buffett thinks AI will do to the businesses he already owns, and his answer is more optimistic than you might expect. AI as a cost reducer, what it does to his existing businesses, the overlooked angle. Most AI investment discussion focuses on which companies will build AI and sell it. Buffett's operational perspective focuses on a different question. Which of his existing businesses will benefit from deploying AI to reduce costs? Geico, Berkshire's insurance subsidiary, processes millions of insurance claims, handles customer service interactions, and manages fraud detection across a massive customer base. These are exactly the categories where AI can reduce operational costs meaningfully. Fewer call center agents needed, faster claims processing, better fraud detection at lower cost. BNSF, the railroad, operates complex logistics networks where AI-driven scheduling, predictive maintenance, and fuel optimization can generate significant operational savings. The Berkshire-owned consumer businesses, from See's Candies to Dairy Queen to Pilot Flying J, all have supply chain, inventory, and customer service functions that AI can make more efficient. Why this matters for Buffett's long-term thesis. Buffett has never needed to own AI companies to benefit from artificial intelligence. His existing businesses, with their durable competitive advantages and pricing power, will deploy AI as a cost reduction tool that improves margins without the risk of owning AI companies at speculative valuations. This is actually the most reliable way to benefit from transformative technology. Own businesses with strong economic foundations that can deploy the new technology to improve their already strong position. The technology makes good businesses better. The risk of backing the wrong technology platform is zero because you are not betting on the platform, you are betting on the business. What you do. For each business in your portfolio, ask, where can AI reduce this company's operating costs or improve its customer experience in the next 5 years? If the answer is substantial, and the business already has strong competitive fundamentals, AI adoption is a free call option on the technology. You get the benefit without paying a speculative premium for it. Angle 5 is Buffett's historical lesson from every previous technology boom, and what it suggests about the AI investment landscape right now. The historical pattern. Technology transforms industries, not stock returns, the paradox Buffett identified. Buffett has made a specific observation about transformative technologies that cuts against the conventional investment wisdom about them. His observation: the more genuinely transformative a technology is, the more it tends to destroy value for investors, because it destroys the competitive advantages of existing businesses faster than it creates durable advantages for new ones. The automobile was one of the most transformative technologies in history. It changed how people lived, worked, and built cities. Between 1900 and 1950, thousands of automobile companies were founded. By 1950, 3 survived. Investors who tried to pick the winning automobile companies in 1910 mostly lost their money. The airline was similarly transformative. It shrank the world, created an entirely new industry, and it has destroyed more investor capital than almost any other sector in history, because the competitive dynamics of aviation prevent most airlines from earning returns above their cost of capital over long periods. How this applies to AI. Buffett has extended this pattern explicitly to artificial intelligence. He has said he has no doubt that AI will change the world, just as the automobile and the airplane changed it. But changing the world is not the same as generating investment returns for the companies doing the changing. AI may well eliminate significant portions of white-collar work. It may transform healthcare, education, legal services, and creative industries. It will create enormous economic value for the companies that deploy it efficiently. But the companies building the AI models and the AI infrastructure are competing in a winner-take-most environment with enormous capital requirements, uncertain intellectual property protections, and rapid technological obsolescence. That combination, high capital requirements, rapid change, uncertain moats, is precisely the environment where most companies fail to generate lasting returns. Buffett's bet, as always, is on the companies that will use AI rather than the companies that will build it. The businesses with strong existing moats that deploy AI to become stronger. Coca-Cola using AI to optimize its supply chain. Geico using AI to reduce claims costs. BNSF using AI to improve railroad efficiency. These businesses do not need to win the AI arms race. They just need to use the tools that the AI arms race produces. What you take from this: the most powerful AI investment may not be an AI company at all. It may be a business with a strong existing moat, proven pricing power, and the operational scale to deploy AI efficiently. One that is currently trading at a reasonable valuation because the market is focused on the AI builders rather than the AI deployers. That is where Buffett is looking. Not at who is winning the AI race today, at which businesses will be stronger in 10 years because AI existed, and what those businesses are currently worth. 5 angles. 1 framework. Applied to the most important investment story of the decade. Let's bring it together. Angle 1. Circle of competence. Buffett does not know which AI company will be the ultimate value capture vehicle, and he does not pretend to. That honest uncertainty prevents him from paying speculative prices for uncertain outcomes. Angle 2. Valuation discipline. The history of technology booms shows that even correct predictions about transformative technology can produce poor investment returns if the price already reflects those predictions. Cisco was right. Investors who bought at peak still lost 80%. Angle 3. The actual bet. Berkshire Hathaway Energy is his AI-adjacent investment, owning the electricity infrastructure that every AI system requires, regardless of which AI companies ultimately win. Shovels, not gold miners. Angle 4. AI as cost reducer. His existing businesses, Geico, BNSF, consumer brands, will deploy AI to reduce costs and improve margins. The technology makes strong businesses stronger without the risk of owning speculative AI platforms. Angle 5. The historical pattern. Transformative technologies often destroy more investor value than they create, because the competitive dynamics of building transformative technology are brutal. The deployers typically outperform the builders over full cycles. Here is the bottom line. Buffett is not ignoring artificial intelligence. He is approaching it the way he has approached every major technology wave of his career, by asking where the durable economic value will ultimately settle, who has the pricing power and competitive moat to capture it, and what that is worth at current prices. His answer, for now: the electricity infrastructure, the AI deployers with existing moats, and patience. Not Nvidia at 70 times earnings. Not the AI startup promising to disrupt everything. The boring, durable businesses that will use AI to become slightly better at what they already do extraordinarily well. The next video in this week covers the one asset class Buffett has famously refused to own for 60 years, even as it hits all-time highs right now. His reasoning is more specific and more compelling than most people know. That video is right here.